and we are in module B right now. So today we'll be dealing with objective questions on risk in banking. So module B is completely about risk. Remember, there are 4 modules. A is about forex, B is about this risk, C is about treasury, and D is that balance sheet management, transparency, corporate governance. Very toughest topics. All of them are tougher ones. Okay. So follow this series completely till the end. So let's start. The yield to maturity of a bond is same as, so this YTM is same as what? Now I'll tell you something. Say this. In any bond, remember, in any bond, there are 5 elements. Always remember, there are 5 elements. Out of these 5, 3 are static. Now look at this. Static means what? They don't change at all. Let anything happen, they won't change. And 2 are dynamic. Okay, D. Okay, dynamic means what? They will change. Now which one are the static ones? So remember this, face value, or it is called as par value also. Some books call this par value. Face value. Then second is period, N, period. And third one is coupon. Coupon, what is coupon? Sure, coupon is a fixed interest which I will be paying on that bond. If you compare this with FD, then the rate of interest which your bank gives, is known as coupon. So these 3 are static. Which is the dynamic one then? Dynamic means first one is market price. Market price. Look at this, price of the bond. And second one is market rate. Both are market. Okay, market rate. Okay. So these 2 are dynamic. Now what do you mean by dynamic? Understand the term. Dynamic means if both of them will change basically. Now there is a rule to this. Now rule is what? If the market rate goes up, the price will go down. If market rate goes up, the price will go down. Okay. This scene you had seen in this October to December 22 in USA. You check right now also. Go on Google and check October to December 22 bond rates of USA. You'll find the same problem. The market rates were going up and the market price was going down. Now what is the question? But your YTM, where is this YTM? YTM is nowhere over here. Where is YTM? So this YTM is called as market rate. See this, there are 4 to 5 names to this YTM. YTM will be called as YTM, yield to maturity, or second one is rate, this market rate, R. All of these are called as R. Okay. Next one you call it discount rate. Discount. Any name can be given. Discount rate. Next one you call it discount rate. Then asking rate. Asking. Okay. So any name can be given. So the YTM of any bond is same as present value of the bond, future value of the bond, the bond's internal rate of return, and none of these. So what is this equal to always? Remember, the present value of the bond, present value formula is totally different. Future value, that formula is also different. Bonds IRR, this can be thought of. So this is, you can call this as IRR also, internal rate of return. So what is YTM? YTM means when I hold any bond, buy any bond and keep it up to the maturity. Understand this, say this. Suppose I buy this bond today and keep it up to the maturity. Maturity means I am not selling that bond till the end. Okay. So I am not selling this bond. So I buy this and say keep it up to the end. So what will happen? What will I get in this? I'll get one coupon. Every year I'll be getting some coupon, year or 6 months, whatever is decided, right? So I'll be getting the coupon, fixed rate of interest, and in the end I'll be getting the complete face value also. So this is known as bonds internal rate of return, or it is called as YT. Clear everyone? Concepts are clear. That is important. Okay. Type yes in the comment section. Type yes if you have understood it, so that I'll go ahead. Okay. We'll see here. It's not important that I'll cover many questions, 20 questions. But just covering the questions, yeah, YTM is same as bonds internal value. Okay, next 20 questions. What's the use? You are in CAIIB. You are not in JIB level. JIB level you can learn. CAIIB you can't learn. Okay. CAIIB you have to understand. Okay. Risk is defined as uncertainties resulting in adverse outcome, adverse in relation to the planned objective or expectations. Now this is simple. It won't take much time, isn't it? Adverse variation of profitability or outright losses, both A and B, and none of these. This is quite simple. See, a risk means what? Uncertainty. Basically, remember, risk means uncertainty. Uncertain. That is known as risk. But uncertain in what direction? In your unfavorable direction. Remember, anything in your unfavorable direction is a risk. Suppose if, let's say, I buy, you only, let's consider one simple thing. You buy a flat tomorrow. Let's say you buy it for 40 lakhs. Done. Now the value of that flat goes up 40 lakhs to 70 lakhs. Are you at risk? No, not at all. Risk is when the value of that flat goes down 40 lakhs to 30 lakhs. Then you are at risk. So unfavorable. So what is the answer over here? Quite simple. A, adverse outcome. Reverse. Adverse means not in my favor. Adverse variation, not in my favor. So answer is both. Isn't it? How many of you have got this right? At the end, what do? You tell me a score. Whatever I'll be giving, see this earlier one, this one, and this one. You tell me a score also. Okay? Next one. Financial risk is defined as financial risk. What is the financial risk? See here, financial means what? Related to finance. Okay? Financial risk is defined as uncertainties in the cash flow. Uncertainties in the cash flow. Second, variations in the net cash flow. Uncertainties resulting in outright losses and all of them. Simple one. Let me see how many of you are right over here. Let me see your answers first. Uncertainties in the cash flow. Is it a financial risk? Variations in the net cash flow. Uncertainties resulting in the outright losses. Which one is the correct one? What do you think? Let me see. How many of you have typed this? Is it A, B, C or D? It is D. Correct? D. Correct? Yeah. Okay. One sec. Yeah. Let me change it to its mod B. Okay. It's mod B. So, move on. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, whatever you want for clearing the JIB and CIB, you'll get it over here. How to download it? We are having a QR code. It's given in the comment section below. Okay? Scan that QR code. You will join our Telegram channel. You can join our YouTube and Instagram also. Follow us on all these three. Okay? So download right now this app also. Okay? Uncertainties in cash flow, cash inflows or outflows can create uncertainties in net cash flow, profits, both A and B, none of these. So uncertainties in cash inflows or outflows, both. You'll say, sir, inflows is okay, how come outflows? See, both are the same. Suppose if sometimes my outflow is, let's say 1 lakh and next month and my outflow is, let's say 1.5 lakhs. It's an uncertain. Similarly for inflow also. So it will result in what? Net can create uncertainties in net cash flow, profits, both A and B. Obviously, isn't it? Both A and B. See, how many of you have written it correct? Type in the comment section. Have you got it right? Yeah. Which of the following is not correct? Now see here, in exam you have to always check what is asked. Sometimes they will ask you what is correct. Sometimes they ask you what is not correct. So sometimes they ask you which one is false. So you have to tick the right one. That's why you have to read the question properly. So which of the following is not correct? Lower risk implies lower variability in net cash flows. So lower risk means lower variability. What do you mean by this term? Lower risk, lower variability. Is it true? We want not correct. Okay, let me get the answer from you. Then I'll explain. Higher variability in net cash flow may result in higher profits or higher losses. Higher risk would imply higher upside or downside potential, and none of these. So higher risk, here, first one, lower risk means lower variability. So that is true? Yes, that is true. Why? Because if my cash flow is less, means the variability is less. 1 month I get it 1 lakh, next month I again get it 1 lakh 1,000 or 99,000. So that's variability is less. Suppose 1 month I am getting 1 lakh, next month I am getting 2 lakhs. After that month I am getting 0. So that is higher variability. So that will be a higher risk. So this is true. We want false, isn't it? What is our target? Our target is false. Higher cash variability in net cash flow may result in higher profits or higher losses. So higher variability. Sometimes I'm getting huge cash, sometimes no cash. So it may result in higher profits or higher losses, both. That is true again, isn't it? True, isn't it? Higher risk would imply higher upside or higher downside. Higher risk, higher upside or higher downside, right? Have you seen this day trading in stock market, in options or futures? Mainly these two only, options and futures. You'll see this side. Higher upside, higher downside. Anyone is just type in the comment section if you have done the trading in Bank Nifty trading. Anyone has done? There you will find it. Higher upside, higher downside, higher risk. So that is also true. So which is false then? None of these. All of them are true. Okay, all of them. Generally in exam, we have a habit that none of these will never be true, means never be the answer. But remember, this is CAIIB. In CAIIB, you can't guarantee anything. You can get none of these answers also. Okay, because remember, higher variability means may result in higher profits and or higher losses. Higher risk would imply higher upside or higher downside. Okay, that is the basic logic of this ALCO department. What is the ALCO department in the bank? Okay, asset liability management. So it basically deals with this higher upside and higher downside. Okay, yeah. Uncertainty with regards to interest rate at which future cash flow could be reinvested. Now, with regards to interest rate at which future fund cash flows can be reinvestment, basically we are talking of reinvestment. Means what? Suppose if I am having an FD, let's say today, I am having an FD at FD, okay, I am having at let's say 8%. This FD is for let's say 3 years. So what is reinvestment risk, or what is the risk in this? After 3 years, will I be getting the same rate of interest of 8% or higher, or higher, or will I be getting 8% or lower? So this is known as which risk? Will I be getting the same rate or higher or lower? So it is reinvestment risk, interest rate risk, gap or mismatch, none of these. What is it now? Name itself. नाम ही काफी है, नाम ही काफी है. We have a dialogue ना in Hindi. बस नाम ही काफी है. Reinvestment risk, isn't it? That is the answer. Whether you will be able to reinvest this money at the same rate or higher or lower, that is basically the risk, isn't it? Right? See here, you'll say, what is this FD? We are talking of BFMs here. In BFM, remember, all your bonds are similar to FDs. Now tell me, what is the difference between bond and FD? Difference is not much. Okay, bond equals to, I'll just give it to you simple. Bond equals to negotiable FD. Remember, negotiable FD. Because what is FD? FD is not negotiable, right? FD is not negotiable. Now, what do you mean by negotiable? If I have a FD, okay, in your bank, tomorrow if I send my brother or tell my brother that what do? You take this FD and go into the bank and get the money in your savings account. Will you give him? Will you give him that? Okay, you have brought this FD, so we'll transfer it to your account. No. How many of you will give it? Tell me. No, because FD is not negotiable. FD money is given only into that account of that same account holder. But bond is slightly different than FD. That's why, what did I say? Those three elements, static and dynamic. These dynamic ones are bonds. Means that is the difference between bond and FD. Otherwise, these three terms, static ones, are same as that of the FD, isn't it? This one, what was it? This one, yeah. See, this for these three terms, bond and FD, both are same. This is the only part which changes bonds. Bond changes because of this. This is not available in FD. So that's why bond equals to negotiable FD. Isn't it? Got it? So where were we? Yeah, over here. So reinvestment. Got it? Subscribe to Officers Adda 24/7 YouTube channel. As I told you, join this channel immediately. Subscribe to it. Click on the bell icon. Here you will be getting the latest updates on IIB from IIB on CAIIB and JIB. Means update means whatever are the changes in the subjects or timings change, then what venue change, many things you get it. Okay, so all these changes. So one is updates. You will be getting the updates, and second, most important, second is free YT series. Free YT series. Right now, what are you watching? You are watching the same free YT series. So same free YT series you will be getting it over here. Okay. So that's why subscribe to this Officers Adda 24/7. Join our LinkedIn. See this, not LinkedIn, Telegram. Okay. Join our Telegram. Then YouTube and Insta. All the three you have to join. Why? Because on all these three we provide all the questions also, free question banks, free tests. Okay, plus videos are available on YouTube also, and all of these they are posted. So that's why subscribe to it right now. Click on the bell icon. Where the bank borrower or the counterparty fails to meet its obligations regarding the terms of agreed with the banks, it is called as, here counterparty is failing. Counterparty fails to meet its obligations. So what do you mean by this? Counterparty is failing. Market risk, operational risk, liquidity risk, credit risk. Type fast in the comment section. Is it A, B, C or D? What do you say? Counterparty is failing. Means what? Say in your case only, you have given a loan and the party over there, the borrower, is unable to pay you. So what is that? Is it market risk? Somebody is typed market risk. No, market risk is not the same. It is credit risk. Remember, it's credit risk. See here, I'll tell you something. Credit risk always is of mainly, I'll tell you, there are many types, but mainly there are two types. Okay, one is counterparty. And second is this country risk. Okay, one is counterparty, second is country risk. Always remember, credit risk is of two types, counterparty and country. Okay. So counterparty means what? Your other party is not paying. Here, it means simple logic is over here. Suppose if your party, counterparty means you have sold the goods. Okay, you are the seller. Okay, seller. And this counterparty is a buyer. Okay, buyer. Now imagine your counterparty is in USA. Okay, your buyer is in USA. So what does it mean? Your USA country is good. Are there any legal problems in USA? No, nothing. Europe, no problem. Only the problem is your party is bad. It can happen anywhere. Okay. So this is counterparty. Country is good, but the counterparty is bad. Second is this country risk. Your counterparty is good. Let's say your buyer is in Afghanistan. Okay. Or second case, Pakistan also nowadays. Pakistan. Even Sri Lanka, even Bangladesh has the same problem. See here, many of the countries have restrictions on transfer of dollars. Okay. So if you have this problem over here, then your counterparty may be good, but the country is bad. Your counterparty is ready to send you the money, but the country has put the restrictions. So that's why this is known as credit risk. Okay. When the bank chooses a wrong strategy or follows long-term business strategy which might lead to its failure. So wrong strategy for the future. It is known as what? Credit, operational, market or strategic. This is a logical question. This is less related to CAIIB, more related to business. Yep. But this risk is there in your CAIIB. It is called as, what is this? A, B, C or D? Credit, ops, market or strategic? Long-term strategy. Okay, I'll give you an example. Nokia. You all might have seen those Nokia phones some 5-10 years back, right? 10, not 10 now, 15 years back, isn't it? 2008. Nokia was the market leader in mobile phones. At that time, it was thought that Nokia will never die, as during the British time, it was thought the sun never sets in the British Empire. Similarly, it was thought that Nokia will never die. But what happened to Nokia? Gone. Nokia is gone. Why? Wrong strategy. Strategic risk. Same thing happens with the bank. When the bank chooses the wrong strategy, it will go down, collapse. Okay, in the long run. So that's why this is known as strategic risk. Always remember this. Return on zero investment would be dash as compared to the opportunities available in the market. So return on zero investment, zero risk investment. So zero risk means what? What do you mean by zero risk? Suppose if I keep the money, I'll give you two options. Suppose if I keep the money in nationalized bank FD, let's say SBI FD, okay. Or second is I keep the money in stock markets, stocks. What will happen? This SBI FD is safe, something 6-7%, whatever I'll get it, okay, roughly. That is safe. But what about the stocks? These stocks might give me, let's say, 30% also, or 0% also, or minus 30% also, isn't it? So that's why this is riskier element. But returns are also the same way. Higher the risk or higher the returns. Always remember, high risk equals to high returns. Always remember this logic. Okay, high risk equals to high returns. So what will be the answer over here? Return on zero risk investment would be dash. High, low, medium, high or low, depending on the type of the investment. What is it? High or low, depending on the type. Somebody is typing this D. See here, if it is higher on the type of instrument, then it becomes the riskier element. We are talking of zero risk. Zero risk will always be low. Treasury bills, T-bills are zero risk instruments. Okay. So now I would urge everyone to join the Sankalpa batch, selection batch. Okay. In this batch, we are covering all the numericals, objective questions, case studies, all the compulsory subjects are covered. And very important here, important is case studies. All the case studies are covered in this batch. You can join the Mahapack as well. In Mahapack, you are getting multiple batches. Plus, you are getting ebooks, tests, video lectures, recorded lectures. You are getting electives also. Any doubt, call on this number, flashing. Okay, how to join this? Okay, let me show you. Go to Adda 24/7. How to go there? See here, I would always suggest you to go through the app, because in the app you are getting 1% extra. How to go there? See this. Go to Adda 24/7 over here. If you are going through the website, go to Adda 24/7. Click on JIB and CIB. Click on CIB November 23. Okay. So here you'll see the Sankalpa batch. Sankalpa batch. Okay. Click on this English. Got it? This one. You'll see the details. Look at this. Online live classes, test series, ebooks. Now click on ebooks. You'll see subject wise ebooks. Look at this. Subject wise. Now click on this subject wise ebooks. You'll see chapter wise ebooks. Means in such details are you getting? You're getting up to up to the level of the chapter. So what all do you want? That is for basically ebooks. Now look at the test series also. Same. Subject wise. Click on the subject. You get module wise and chapter wise also. So that's what is needed, isn't it? When you get the material in such details, the tests, the ebooks, the classes, then you can definitely clear it. Okay. So that's why I would suggest to join this fast, and importantly, 80% off is going on. Such a huge discount we never get. Okay. How to join this? Okay. Click on buy now. Fill in the details. See this. Click on continue. Code is already applied. See. Fill in the details. 23,999 reduces to 4,799. Huge discount. Okay. You can join the Mahapack also. In Mahapack, you are getting multiple batches. Let me show you. See this. Go to Mahapack. See this. Right now, on the Mahapack, there's a double validity offer going on. Plus 80%. See this. 80% off plus double validity. Means you buy for 6 months, you get for 12 months. You buy for 12 months, you get for 24 months. Okay. So both these packages are having the double validity of you should buy any one of them. Okay. Now in this, I'll tell you, as I told you, you're getting test series, ebooks, videos, online live classes, interactive classes, recorded sessions. Okay, you can go through the highlights here. All of them are given over here. Okay, so that's why join it fast. I'll be back tomorrow with another series. Till then, keep studying and do join the batches ASAP because exams are near.